Let's go through every financial trap you will encounter on your path to building wealth and how to avoid them. Starting with number 1. Over concentration. This is also known as holding too much in one asset and is typically defined as when you have a single stock or an investment in your portfolio that makes up more than 10% of your overall holdings. So if your portfolio is worth $100,000 and you have $50,000 in Google stock, that might not be the best idea. When this happens, you are basically betting on one outcome being correct, which is that a lot of your financial future is going to depend on how well Google stock is performing. If you'd like a cautionary tale as to why you might not want to concentrate too heavily in one single asset or stock, consider the tech company Intel. They were once a darling tech stock during the dot-com bubble that peaked around $65 a share. Now, if you had bought it back then, you can see by the chart that is on the screen, you would still not have broken through its all-time highs back in 2000. Even with the recent run up Intel has had with the AI news, compare that to the performance of the S&P 500 since 2000, which has 5x's since then. So, what we are basically looking for in our portfolios is a consistent gain over time. And over-concentrating can actually be a big trap. Not only could you jeopardize those consistent gains, you could also get emotionally attached to that single holding. And that is the opposite of rational, objective investing. Most portfolio managers and financial advisors like to see no single stock exceed 5 to 10% of your total portfolio. So take a look at yours and let me know if you're too over-concentrated. That is a trap for how to invest your money. But what about how you spend it? So trap number 2. Today is lifestyle creep. This is one of the most common traps that we talk about on this channel, and that is when your expenses increase alongside your income. All right. Take a look at this table from Goldman Sachs. I know it is going to be a little bit crazy. These are the percentages of workers that are saying that they are living paycheck to paycheck. You can see that someone making less than $50,000 per year, 57% of those people say that they are living paycheck to paycheck. But what is crazier to look at is the higher income ranges. 41% of people making over $300,000 a year say they live paycheck to paycheck, and people making over $500,000. So that is $500,000 a year. By the way, 40% of those people report that they are living paycheck to paycheck, which should be really alarming to you. The true way to build wealth is by keeping your lifestyle cheap and modest while your income increases. And that is actually one of the lessons of the book, The Millionaire Next Door. The author studied hundreds of millionaires in the 90s and found that the best accumulators of wealth kept their spending habits the same, while their income grew at a rapid pace. I also think if you become so obsessed with possessions, you may lose sight of what is actually important in life. And that is why I think true fulfillment can often come from meaningful experiences, rather than accumulating things. When you focus on experiences like going to new places, learning new skills, or simply spending quality time with your loved ones, you will create lasting memories and personal growth that, in my opinion, no items can provide. So whenever you get a raise or a promotion, you're going to start to make more money. And you might be tempted to show off that money via your lifestyle. But for your own sake, I would say, just try not to get involved in this game. Trap number 3. Today is being tax inefficient. So, I know taxes are probably the last thing you want to hear about today, but taxes are likely your single largest expense. More than your rent, more than your car, more than anything else that you spend money on. You want to be strategic about taxes, because if you're not, you're seriously just leaving a bunch of money on the table. Most common mistakes I see are people not taking advantage of tax loss harvesting, holding investments in the wrong accounts, and underestimating how much a capital gains tax bill will actually cost them when they sell a position. For holding investments in the wrong accounts, something I see quite often is that people put their high dividend stocks in a taxable brokerage account instead of a tax-sheltered account, like a Roth IRA or an IRA. When you do the former, you actually owe taxes on dividends every time you receive them. And that is something that is just inefficient. There are some proactive things you can do to reduce your tax liability. For example, maxing out your 401k, your IRA, or even your HSA. If you are holding stocks, you might want to consider holding them for longer than a year to qualify for long-term capital gains rates. And lastly, learn about tax loss harvesting. Because strategically selling your positions that have losses in order to offset realized gains can actually reduce your tax bill quite a bit, especially at the end of the year. The IRS will always take a cut of taxes, and your job is to make sure that you're not paying them more than you should be. Speaking of not paying more than you should, the same logic will apply to your debt. Because trap number 4 today is being lazy about refinancing even when it could save you a lot of money. If you have a mortgage, the general rule of thumb is that a 1% drop in your mortgage rate is where refinancing really starts to make a lot of sense. Let's say you have a $400,000 mortgage on a $500,000 home, and your current mortgage rate is 7%. If you were to refinance to 6%, your payment goes from $2,661 per month at the previous rate to $2,398 per month. And that is about a $263 per month savings that you are going to get. Now, typically refinancing does cost some money, so it usually runs about 2 to 3% of your total loan. On $400,000, that could be anywhere from $8,000 to $12,000 that you might be paying in refinancing fees. So for our sake, let's say the fee to refinance is $10,000. To break even on those fees with the savings you get every single month, you need about 38 months to recoup the cost. So really then, the key question becomes, how long do you plan to stay in your home? If this is your forever home, or you want to stay in the home for at least 5 to 7 years, a 1% drop in your rate could make a lot of sense. If you're moving in the next year or two, then it probably doesn't make sense to refinance at all. This trap, I think, is relevant to anyone carrying a high interest rate, whether that is your mortgage or your auto loan. If you locked in a mortgage or loan during 2023 or 2024 when rates were at their highest, it is probably worth running the numbers right now. If you're looking to compare some mortgage offers, I will leave a link down below in the description to a tool from Bankrate.com that is completely free that you can try out. And that way, at least, you can compare and see what today's market looks like. Now, trap number 5 is going to surprise you because it is not about money at all. It is about something that you can never get back, and that is your time. Because one of the biggest financial traps people fall into when they're building their net worth is that they work too much. This is a financial trap, but also just a general trap for your well-being. In terms of financials, as your net worth grows, your time starts to become exponentially more valuable than your labor. So I'm going to give you a very extreme example here, and bear with me. But this is just to illustrate the point of the value of your time. Let's say you have $5 million bucks in a portfolio, and you get a conservative 5% return per year. That is $250,000 per year. Your money is making. That is $684 a day, just from your portfolio. So at what point does an extra hour of work start to have diminishing returns compared to what your capital is already doing for you? That is what you should constantly be asking yourself. What I've noticed, though, is that people who are successful in their careers, well, they sometimes are workaholics, even though they've already made enough money to live a fulfilling life. Even though they already have enough money to perhaps retire early, they still continue working way too much. In fact, one of the top regrets of people on their deathbeds is that they worked too much throughout life and didn't get to enjoy it. So I would say, work hard when you're young and you're establishing yourself. But if you're constantly growing your net worth, and your portfolio is growing, and your income is growing too, maybe just audit how much you're working. The last thing I would want to see you do is work 80 hours per week, and all of a sudden you are the age of 65. Trap number 6 today is overconfidence from early success. Now, if you are someone who finds themselves quite successful, especially early on in life, This trap is for you, which is that you could become so overconfident from your early success that it could actually sabotage you. I'm gonna give you an investing analogy here. I had a friend who liked to diversify his portfolio into 10 stocks at all times. And that was his entire portfolio, just 10 stocks. That already falls into trap number 1 today, which was over concentration. But it is also incredibly risky. But that is what he was going for. He wanted high risk, high reward. Now, this strategy admittedly worked quite well for him in 2023 and 2024, when he picked 10 stocks that did well those years. I mean, not all of them were winners, but let's say he picked 8 great ones and 2 bad ones. Overall, his portfolio did really well. So after this happened, he suddenly had this bravado about him, that he suddenly believed he was the greatest investor of all time. So what did he do? Unfortunately, this person doubled down, and they started to take bigger and bigger risks. Those 10 stocks that he had in his portfolio, he decided to concentrate even further and just go down to 5 stocks. He would even buy call options on earnings dates and trade on margin from time to time. And I recently heard from this said friend, and he is down over 30% in his portfolio this year alone, when the S&P 500 is only down about 2% overall. So the hard truth here is that sometimes a 2 to 3 year hot streak doesn't make you a great investor. It just might mean you got lucky in a bull market. The longer your overconfidence goes unchecked, the more painful the corrections might be. Statistically, 90 to 95% of day traders lose money over a long period of time. So I would say, if you're trying to get into day trading, just don't. Let us move on to trap number 7. And that is when your finances become too complex. When you start growing your net worth and earning a good income, you may start to diversify your investments into many different places. People will have multiple brokerage accounts, multiple bank accounts, angel investments, private investments, and they might even enter into real estate partnerships. According to this article from DIY Investor, while more than 82% of high earners say they feel confident making investment decisions involving 6-figure sums, nearly a third of those admitted that they have just pretended to understand a major investment decision despite not fully grasping what they were dealing with. One of the key people interviewed in this is a CEO of a wealth platform in the UK called Sidekick. And he states that when portfolios tend to reach a certain size, all of a sudden structure, risk, and fees matter much more. The trap here is that this financial complexity in your portfolio will create blind spots. The more moving pieces that you have, the easier it is to miss a hidden fee, misunderstand a risk, or just make a wrong call. There's really not too much actionable advice that I have for you in this section. I would just say that if your net worth and your income are growing to a point where it is getting a little complex, maybe that is when you meet with a financial advisor and you consult with them for any next steps. Trap number 8. A day is being too illiquid, or what a lot of people like to call being asset rich but cash poor. This is when the majority of your wealth is being tied up by things that you can't easily access. So let's say you have your entire net worth in your house. On paper, you might look really wealthy, but if it came to investing in a new opportunity, it is not like you can liquidate your house in the next 7 days. According to Ben Carlson from Ritholtz Wealth Management, he says, today, millionaires rarely have anywhere near $1 million to spend however they want. For the barely millionaires, households with a net worth between $1.72 million, the vast majority of that wealth is illiquid. They typically had 66% of their wealth tied up in a primary home and retirement accounts. In 2023, the general rule of thumb is to keep 3 to 6 months of living expenses in liquid cash at all times. And I would even argue that if you're someone who is growing their net worth, and you have a high income and low expenses, that perhaps having a little bit more cash flow or cash on hand is a nice thing to have in case opportunities come up for investment. Also, when you are buying into an asset that ties up your money, you want to think about how long that money is going to be illiquid for. If you're okay with it being tied up for a certain period of time, then I think that is fine. The mistake I think people make more often is that they commit money to something that they might actually need in the future, and then they find themselves completely screwed when that happens. That is the trap that we want to avoid. Trap number 9. Today is delaying saving for retirement. And this comes down to the fact that I think that everyone is a little bit lazy and likes to procrastinate, especially deep down inside. One of the most important factors in how much you retire with is not actually how much money you earn. It is how early you can start. So this is one of the most powerful graphs in all of personal finance. And it is the benefit of saving early. Here is what happens. If you save $1,000 per year and earn a 7% annual return on that money, starting at either age 25 or at age 35. Now, on our channel, we are definitely aiming to save more than $1,000 per year. But just to illustrate how big of a difference starting earlier matters, you can see that the person who starts at age 35 essentially ends up with half the amount that the person who started at 25 ends up with. If you do have a little bit of a late start, I think that is still okay, because the best time to invest was probably yesterday. But the next best time is right now, today. Here is a really nice summary on trap number 9. And the way to avoid it: save more, stay out of debt, live within your means. And if you can do number 4, you are well on your way. Save at least half of every raise that you earn. That means if you get a raise from $100K to $110,000 per year, you want to put at least half of that $10,000 raise towards retirement. That is going to serve you really well in the future. And that is an easy rule to live by for any future raises as well. Trap number 10. And the one I want to leave you with today is being underinsured. If you're someone who has watched this video, you're likely on your path to building wealth. But one of the ways that you can keep that wealth is by making sure that you don't lose it in the first place. As your net worth grows, your insurance needs are going to grow with it. Your home is going to be worth more, and you have more assets that can be targeted in a lawsuit or a robbery. When it comes to your assets, you always want to be revisiting what the stated value of your assets are with your insurer. That way, you're always up to date with how much insurance you qualify for in case something were to ever happen. I actually heard Graham Stephan say on his podcast that he does his insurance check every Valentine's Day, which I thought was a great idea. Not that it is the most romantic thing, but the logic here is that Valentine's Day is about taking care of the people that you love. So what better reminder to make sure your assets and your family are protected than to talk to your insurance provider on the 14th of February? I mean, it is kind of funny. You don't have to do it on February. But I just thought that is Graham's version of love, which I do appreciate. Anyway, that is just a really good reminder to stay covered and to make sure that your coverage is actually covering what your stuff is actually worth. Alright, if you enjoyed this video, you'll probably enjoy my video on every way to build your net worth in 2026. I'm gonna leave it right up here. Also, let me know in the comments what the biggest financial trap you have fallen for before. I would love to hear from you. And I will see you guys in that video right up here, or a future one on the channel. Alright, thank you for being here. Peace.